Imagine you have two friends, Alex and Jordan. Both start investing at age 25. Alex starts randomly picking stocks, going with his gut, and hoping for the best, whereas Jordan follows a structured investment portfolio. Fast forward 20 years later, and Jordan has a comfortable retirement fund, while Alex is financially behind and struggling to find out what went wrong. So why the difference? Today, we're breaking down how to build an investment portfolio the right way, whether you're a beginner or a seasoned investor. We'll go over what is an investment portfolio, how to structure it properly, and how to design it based on your goals. Stick around because I'll also provide real-world examples so you can see how the rich investors actually build their wealth. So let's dive into it. Simply put, an investment portfolio is a collection of assets, stocks, bonds, real estate, even cryptocurrency, designed to grow your money over time. Think of it like a balanced diet. You wouldn't just feed your body fast food every day, would you? The same applies to investment portfolios. Your portfolio needs a balance of carbs, proteins, fats to stay healthy and balanced. Imagine a 35-year-old school teacher named Sarah. She puts all her money into some tech stocks because she believes in the tech industry. Suddenly, the tech industry crashes for a few years and her portfolio goes to. However, if Sarah would have diversified and spread out her asset classes, putting some of her portfolio into stocks, some into bonds, and some into real estate, her investment portfolio would have been fine, or at least the impact minimized. That's why diversification is key. So the structure of your portfolio depends on your risk aversion or risk tolerance. What's your level or comfort with risk? Your timeline horizon. How long are you planning on investing that money for? 5, 10, 15, 20 years? And also, what are your financial goals? Are you planning to use the money for retirement, for wealth building, or for passive income? Meet David. He's 25 and he just started his career. So he has time on his side so he can allow for more risk because he has decades before his retirement. So his portfolio might look like 80% stocks, 15% bonds, and 5% alternative investments such as real estate or cryptocurrency. Now, meet Lisa. She's 55 years old and will be retiring within 10 years. So we don't want Lisa's portfolio wiped out by a sudden stock market crash. So her portfolio looks a little bit differently. It consists of 50% stocks, 40% bonds, and 10% real estate. This is called asset allocation and is crucial for long-term investments and understanding investment portfolios. I actually made a video on this very subject, which I'll link up above. Your portfolio should match your financial goals. Here are 3 different types of investment portfolios.
Growth portfolio. High risk, high reward. This is perfect for younger investors looking for maximum returns. It focuses on stocks, exchange-traded funds, and emerging markets, investments that have the potential to grow significantly over time. For example, let's say Steve invests $10,000 in the S&P 500 at age 25. With an average 10% return, that money grows to $67,000 by age 45 without him adding another dime. Income portfolio. Steady cash flow. This is ideal for retirees or anyone looking for passive income. It's built around dividend stocks, bonds, and real estate investment trusts, assets that pay you regularly. For example, Jane, a 60-year-old retiree, built a dividend portfolio that now pays her $2,000 a month, covering most of her expenses. Balanced portfolio. Growth and stability. If you want solid growth but also some protection during downturns, a balanced portfolio might be the right choice. A typical mix is 60% stocks and 40% bonds, giving you a balance of risk and stability. For example, Mark at age 40 follows this strategy so his portfolio continues to grow, but he is not fully exposed when markets drop.
So there you have it. 3 unique investment portfolios specifically tailored for a person depending upon their needs. So which investment portfolio is the best fit for you? Let me know in the comments. In case we haven't met, I'm Aaron, a 20-year corporate accountant and analyst living in Western Canada. I talk about personal finance, investing, and investment portfolios. I've been investing for a number of years, so I think it's safe to say I know my stuff. If this all sounds like something you'd be interested in, consider subscribing to my channel. Even smart investors make these common investing mistakes. These are 3 mistakes to avoid. Number 1, putting all your money in one sector or basket.
You're a very smart guy. This is a very dumb thing to do.
No one can predict the future. Just look at Enron and the Lehman Brothers. even they collapsed. Number 2, trying to time the market. Trying to think, I know better, I know what the market's going to do. No, you don't. I have no clue, and I'm pretty sure you don't either. It's better to use dollar cost averaging, investing consistently at set intervals. Number 3, ignoring taxes and fees. High taxes and fees can quickly eat into your returns. Just look at the fees charged on mutual funds from banks. For an example, Kevin invested into a mutual fund with only a 2% fee. Over 30 years, he would have lost $200,000. Always check the expense ratio and management fee.
Do it. Do it now.
Now, this isn't a one size fits all. Everybody will be different. That's why so many investors can't uniquely tailor advice for YouTube, because it's reaching such a wide audience. And if you tailor it so specifically, chances are it will get no views. That's why many people, they're not allowed to give out investing advice, right? Because it depends on every person's level of risk, their debt level, where they live, their age, so many factors to take into account. But use this as a general guideline and make your decisions from there based on your unique financial situation. A little bit of background on me. Much of the education and experience that I have in my background, well, I'm passing that on because this is where my strength is. I feel I can share and people can benefit from this. So I can say, well, don't make these mistakes that I've made in the past, or I would have done this differently, or here's where I majorly screwed up. I would do this. And the mistakes I've made, I wish I could go back 10, 20 years and tell my younger former self, hey, Aaron, don't do this. This is what you want to do instead. And so that's who I make this channel for, a younger version of myself. So I hope this helps someone out there, because that's my goal. I want to reach a younger version of myself to hopefully steer you in the right direction that I would have taken. And if you're older, this is practical everyday principles I try to explain for the sandwich generation, for parents who are looking after older, aging parents, but also their children as well, and how to construct their investment portfolios. The best advice that I can give, that I've learned over 10, 20 years, and pass that on to you so I can say, look, I'm a reputable, reliable, trustworthy guy. This is what I would do in most cases. And consider that, and once you begin learning about investments and how to best apply what I'm teaching, you'll be able to judge for yourself and assess the quality of the information I'm giving you. Like I said, I'm a 20-year corporate accountant and analyst, talks about personal finance and investing, and I try to make it fun, entertaining, and engaging, the best that I can. If this sounds like something you'd be interested in, consider subscribing to my channel. If you're curious about where 90% of your returns come from in your investment portfolio, it's not from stock picking. Click this next video here to find out the answer.